You've probably seen The Big Short, which shows how heroes shorting or betting against the US housing market in 2008 and making millions of dollars. And shorting is a great way to rack up fast profits, so long as you know what you're doing. So in this video, I'm going to reveal how anyone, regardless of whether you're a suit or not, can get access to short selling and profit from these types of trades. We'll go through examples and also my methodology for shorting for profits. But first of all, can you lose everything by shorting? And the answer's yes, absolutely, but only if you're a professional trader. And this is something that you need to meet strict criteria for and sign up to. And unless you've done that, then you're going to be classed as retail by default, which means you can't lose more than what you put in, like a normal share trading account. But in The Big Short, Christian Bale goes to the bank and has a derivative called a swap created.
I want to buy swaps on mortgage bonds, credit default swap that will pay off if the underlying bond fails.
You want to bet against the housing market?
But for traders like you and me, we can simply go to our broker and open a short trade with a spread betting account. And before you decide to open a short trade, you do need to understand some of the strategies and how shorting actually works. So shorting or short selling is a trading strategy where a stockbroker will borrow shares from someone else and allow you to sell those shares with the hope, obviously, of buying those shares back cheaper, then giving the shares back to the broker and back to whoever owned them, and then you pocket the difference between the sell price and the buy price. Got it? Now, unlike the traditional approach to buying stocks and hoping they go up, short sellers actually want the price to go down, because the more the shares go down, the more money short sellers make. If you're confused, don't worry, because we will go through an example of how all this works. So let's say there's a stock called Trashco and we think it's a load of garbage. So obviously we wouldn't want to buy it because we think it won't go up because it's garbage. And a lot of investors would move on to look for another stock. But because we know that we can short stocks and make money on stock prices going down, what we then want to do is short the stock. So we then go to sell the stock, and if there's enough borrow available, then your broker will let you open the position, which means you'd have an open short position. So let's say that you sold 5,000 shares of Trashco at 100 pence. This would mean you have the sale proceeds of £5,000 and an open short position, which means you do need to give those shares back. And obviously that money wouldn't all be yours, because you still owe your broker 5,000 shares of Trashco, and whenever you buy 5,000 shares of Trashco back, you'll be able to give the broker the shares you borrowed back, which is known as covering your short, and then you'll pocket the difference, assuming that you made a profit. So if the Trashco share price went down to 80 pence, you could buy 5,000 shares back for £4,000, which would then give the shares back to the broker, and you sold for £5,000, you're now getting £4,000, and so you would keep the £1,000 difference in profit. Sound good so far? Well, what if the Trashco price went up to 120 pence? Well, you'd still owe your broker 5,000 shares. That would be now worth £6,000, which means you'd have a paper loss of £1,000. And if the Trashco price went to 200 pence, that means you'd now be at a loss of £5,000, which was your original position. And the price could even go higher, which is why shorts have a theoretical unlimited loss, because there's no limit on how high your share price can go. Now, we mentioned this before, but if you're a retail client in the UK, which you automatically will be under the European Securities and Markets Authority regulation introduced in 2018, unless you meet a certain financial criteria and you've signed up to become a professional trader, then you cannot go into negative equity. And basically this means that you can't lose anything more than what you deposit into your account. But so far with your short trade, you've borrowed shares and sold them and not actually paid for them. So how come the broker will let you do this? As I said earlier, shorts are a derivative, which is a fancy finance way of saying a contract based on an asset. And as these contracts are leveraged trades, the broker will demand collateral for allowing you to take the position, which is often known as margin. In the UK, you'll generally be asked to pay for 25% of the position as margin. So for your Trashco trade that had exposure of £5,000, you'd need to put down £1,250 as margin in order to finance the position. And because you're not allowed to go into negative equity, if your P&L gets too low, then your broker will contact you and ask you to put more cash in your account. This is to finance the position because otherwise you might find you get closed out. Your account equity is simply the funds in your account plus your P&L. So for example, if you had £10,000 in your account and you opened a £5,000 position in Trashco, then you'd have exposure of £5,000. But if that position became worth £4,000, that means you'd have £1,000 in profit. So your account equity is funds plus your P&L, which in this example would be £10,000 plus the £1,000 paper profit, giving you account equity of £11,000. And if your position in Trashco was showing a £2,000 loss, then you'd still have the £10,000 funds so long as the position is open in the account, but the account equity would now be £8,000. And if your account equity gets to below 25% of the funds in your account, you'll likely be asked to increase your funds in the account, which, as we've discussed, is a margin call. But because your broker is lending you money for a leverage trade, they will charge a financing fee, which varies depending on the interest rate and the added percentage the broker adds on. For example, with IG, the current interest rate benchmark used is SONIA plus 3%. So you can see how this financing fee adds up over time. Another characteristic of a derivative is the leverage within the trade itself. Now, leverage is a double-edged sword because whilst it can magnify your gains on your money, it can also just as quickly magnify losses. So just because you have 4 times leverage doesn't mean that you should use 4 times leverage. If anything, leverage does need to be earned. Now, as a short position is what's known as a swap, which means you've swapped the cash flows and taken the inverse of long position. You will need to pay for any dividends the stock pays out. So whereas if you're long and holding the stock, you receive a dividend. If you're short, then you've borrowed the stock from someone else, but they remain the owner, so that means you have to pay them the dividend. Obviously, if you're short a stock that doesn't pay any dividends, then you don't need to worry about this at all. But one risk you do need to know about is the risk of having the stock recalled. So the borrower can request the stock back at any point, and you're obliged to provide it. You will be given some notice usually, but if you shorted the stock at a loss and the shares you've borrowed are then recalled, then you might end up having to close the trade at a loss, even though you don't even want to. So even if Trashco was going to fall, it could put out a piece of news that drives the stock up in the short term, and you end up being recalled only for the stock to go where you originally thought it would. So it is possible for you to take a loss on a position, even if the long term you would be right, which is one of the complexities of shorting. And this can never happen if you're long and you physically hold the stock, but it is a big risk for shorting. And this can also contribute to what's known as a short squeeze, which is where traders will rush in to close, and what they do is they push the price up because everyone's trying to buy to close out their short. And remember, professional traders and professional shorters do have unlimited risk, and so they may be eager to close out as they see the losses mount up or the stocks recalled. And then these moves can even be exacerbated by people buying the stock to go long, and other traders who want to squeeze the shorts may also buy in order to put pressure on them to close and drive the price up further. There's also a skewed risk to reward payoff when it comes to shorting. So not only do you have the financing and the risk of a stock recall, the reality is you can only make 100% on a short because the lowest price a stock can go is 0, and it doesn't matter whether you start shorting at 300 or 30. If the stock goes to 0, then you still make 100%, and the risks even increase as the stock falls further. Whereas if you buy a stock, it can double, triple, or even quadruple or more, and your downside risk is capped at 100%, unlike a shorter who can wear unlimited risk. And short selling can be great if you're shorting a company with deteriorating fundamentals or a falling price and you're aware of the risks, but most traders prefer to go long because the upside is far greater and the risks are fewer. And I mentioned earlier about professional traders having unlimited risk, but there are several things that I do as a professional trader which allows me to generate higher profits than most amateur traders. So check out this deep dive here where I'll show you the exact 3 things that you need to be asking yourself and how you can apply them to increase your P&L. Thanks for watching, and I'll see you in the next one.